Howdy, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Monday, March 3rd, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you'd like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, how serious is President Trump regarding tariffs? Our answers are, we may learn the answer this week. Until about a week ago, markets were assigning a low probability to the risk that President Trump may be intentionally kitchen sinking the U.S. economy and asset markets to create a low comparative base that flatters economic growth and market returns throughout the duration of its presidency. Ronald Reagan did that while instituting a bevy of supply-side economics reforms that made him arguably the most popular Republican president of all time. Investors would be remiss to assume President Trump does not aspire to replace President Reagan in this regard. This week is a big week for investors to gauge the risk of a kitchen sinking because of Tuesday's self-imposed deadline could mark a potential seismic shift in the U.S.'s trading relationships. Specifically, President Trump is planning to implement a 25% tariffs on all imports from Mexico and Canada with a reduced 10% tariff on Canadian energy. President Trump has also indicated he will double the 10% blanket tariffs on Chinese imports to 20%. These measures would impact over $1.3 trillion in annual imports. All told, when we introduced our Triple S's theme last fall, we did so with the view that the economic outcomes President Trump can control via executive order, specifically trade and immigration, were skewed negative and likely to front-run the economic outcomes President Trump needs Congress to legislate, like tax cuts. Given this precondition, it may be the case that President Trump is doing his best Ronald Reagan impersonation by kitchen sinking the economy and asset markets. Tariffs and restricting immigration are undeniably stagflationary. As such, the onus shifts to the Fed to use its policy tools to offset that and prevent a global debt refinancing air pocket. If the Fed does not act forcefully and proactively within this window of economic weakness to prevent a deepening U.S. growth scare, a further unwinding of popular yen carry trades is likely to trigger the crash in risk assets that our positioning model has been warning about for months. The global debt refinancing clock is ticking. Tick, tick, tick. Transitioning to our 42 macro dashboard here, as always, I'll wrap up with a question from our community. This one's regarding debt refi liquidity impact. It says, hi, Didi, if I understand correctly, your forecast of liquidity need is driven by a 4-year lack of debt issuance. It's 4.5, but we'll keep that neither over there. So for refinancing wall in 2025 drives a spike in liquidity need, but when debt rolls, doesn't it create an equal amount of new liquidity from the previous debt holders getting paid out? Some debt holders will roll to new debt and some will cash out and new holders will come in. Wouldn't the liquidity need be offset by new liquidity creation, except for the impact of the Fed letting holdings roll off its balance sheet and needing to make room in the private sector? So great question. This is, pretty esoteric, finance stuff, but I think it's worthy of unpacking because it'll help investors understand, what we mean by a global debt refinancing air pocket, which essentially means that the balance sheet capacity is not there from the global investor community to roll the total amount of existing stock, or at least the amount of expiring stock of debt in a potential window of time. And historically speaking, when that happens, it forces investors to sell other assets or forces growth to slow significantly, or both of those things. And you typically see significant corrections and or crashes in risk assets. In fact, every significant correction or crash in risk assets that we've seen since 2008, since the global financial crisis, has been a function of, been contributed to by a global debt refinancing air pocket. So going back to the question, it says when debt rolls, does it create a new amount of liquidity, new liquidity? So it's not new liquidity. I mean, the debt is already there. You're just essentially rolling it. And the problem with rolling it, especially in into a higher interest rate regime, is that the cost of the debt is increased. The cost of funding the debt may increase. The cost of foreign currency, the cost of funding the debt may increase in terms of foreign currency, FX swaps, interest rate hedges, things of that nature in terms of the derivatives market. And then you also have inflation as well. So you need more debt. If the company wants to roll that debt and also, expand operations, then you got to think about things like inflation potentially adding to that burden. And so ultimately what happens is, the roll creates new demand. The roll does create liquidity, but as the question implies, some debtors will roll new debt and others will cash out and new holders will come in. And to me, that's the most important point. New holders may not come in, especially if liquidity is declining. That means global investor balance sheet capacity is declining, so new holders cannot come in. There is no ability for them to come in and roll the debt. That's obviously a direct headwind, when liquidity is going down. And even if liquidity is going up, they may choose to roll those proceeds into different asset classes. Maybe they want to raise cash. Maybe they want to, allocate to sovereign debt. Maybe they want to go further out of the risk curve. We don't know the answer to that, but the risk is always that you have a mismatch between the growth of liquidity and the growth of the global debt refinancing demand, because ultimately it makes this whole entire process harder. What makes this process very easy and very smooth, and the fact that we don't have significant corrections and/or crashes in risk assets every year, is because we have liquidity generally trending higher, and it makes this whole entire process smooth. But we've been calling out for 6-7 months now that the number one risk for 2025 is that liquidity, because of some of the policies we're seeing with respect to President Trump's immigration and trade agenda. Some of those policies are explicitly negative for liquidity. And in our opinion, some other policies could potentially be negative for liquidity as well. And so, not just with President Trump, but globally as well. And so the issue is that if liquidity does not accelerate markedly, we know there is a significant historic acceleration in the amount of global debt refinancing demand this year, largely as a function of the amount of debt that we saw issued in 2020 as interest rates were low. We had a lot of companies, we had a lot of governments and companies and consumers in the mortgage business, or mortgage in the mortgage market, term out their debt, and that was contributing to the resiliency of the economy. But a lot of that debt's starting to come due now. And that's the issue. And it's coming due at a higher interest rate regime. It's coming due at a time where investors may not want to create additional balance sheet capacity to, especially for things that are further on a risk spectrum, like corporate credit. So, it's not as simple as it sounds. You're just kind of getting back to the question. Rolling debt is not as simple as it sounds. There's a lot more considerations that we have to consider as investors, including, the balance sheet capacity, the yields, the spread, the inflation, investor demand for these assets, and how that changes over time based on where we are and the key macro cycles that matter. So hopefully I did a decent enough job explaining that. This is really deep esoteric stuff, obviously not easily unpacked in a macro minute format. So obviously, if you guys want to get deeper insights on this kind of stuff, hop into our community chat here, and we can have a deeper discussion. So we'll wrap it up there. Darius Dale here, presenting our macro minute for Monday, March 3rd, 2025. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.